Welcome. Thanks for joining the webinar. On behalf of the entire Tavola Group team, we're excited that you took time out of your day to join and learn more about proactive tax planning, the mid-year review for business owners specifically, but we'll tie some things in here for those real estate investors that joined as well. Joining me today is Nathan. He's one of the managers of accounting and tax here at Tavola Group. He is one of the proactive tax planners, to be more specific, and he'll be able to answer any and all of your questions. Just like all of our prior webinars, we'd like to have an interactive session. So as questions come up, please put them in the chat. I'll be monitoring that throughout this entire session. For those that don't know me, my name is Matt Schumacher. I'm the Director of Tax Planning here at Tavola Group, and I'll be the host today. As we get started, just want to start with a couple quick disclaimers. Tavola and its employees do not provide investment, tax, or legal advice. We advise you to take this as an educational purpose only and advise with your appropriate CPA, lawyer, accountant, or professional for your specific set of circumstances. So at Tavola, our name reflects our philosophy. In Italian, Tavola means table, and that's exactly how we see our role in having a seat at your table. As a business owner or real estate investor, you already juggle a lot. You rely on trusted professionals, attorneys, CPAs, advisors, each with their own expertise. Too often, though, those experts work in silos. We believe they should work together. That's where Tavola Group comes in. We're designed to be part of that ecosystem, whether that means one seat at your table or several. Our goal is to collaborate seamlessly with your team to anticipate needs, reduce risk, and design tailored strategies that move you forward. But our approach goes beyond numbers and spreadsheets. We believe wealth should serve a greater purpose: your family, your legacy, and your freedom. That's why we built systems that make your experience smooth, proactive, and efficient, freeing up more of your time to focus on what's truly matters most. When we talk about tax planning, we don't just mean filing a return once a year or checking boxes for compliance. True tax planning is proactive. It's about designing a strategy that aligns with your goals, not just reacting to deadlines. The reality is the tax code isn't black and white. It's filled with gray areas. And while social media really is crowded with so-called experts sharing quick tips and tricks, that's exactly where real expertise like Nathan has and good judgment like Nathan has matters the most. At Tavola Group, we see tax planning as a partnership. We take the time to understand your current situations, then build a strategy that supports both your short and long-term goals in the most tax-efficient way possible. Our role is to help you minimize liabilities, preserve wealth, and ensure full compliance while staying ahead of ongoing changes in the law. Most importantly, we want to equip you with the clarity and confidence to make the best financial decisions for your unique situations. So why does proactive tax planning matter? Because effective tax planning helps you do more with what you've earned. It's not just about saving money on a return. It's about putting your wealth to work in ways that supports the bigger picture. Improve your cash flow, keeping more of what you earned available for growth, reinvestment, or personal priorities. Reduce audit risk, building strategies that stand on solid ground so you can move forward with confidence. Greater control over long-term goals, whether that's funding retirement, scaling your business, or creating a lasting estate plan. And then last but not least, flexibility when life changes. Having a proactive tax plan gives you the ability to adapt your strategy in real time as opportunities or challenges arrive. At its core, tax planning is all about alignment, making sure your money and your goals are working together, not against each other. A common misconception is that tax planning is only for the ultra wealthy. This simply isn't true. At Tavola Group, we work with real estate investors and business owners across all stages of growth, not just those at the top. The reality is, if you're making significant financial decisions, you should be making them with a tax plan in place. Whether you're purchasing or selling real estate, growing and scaling a business, planning for retirement, or structuring your estate and legacy. A proactive tax strategy can make the difference between missed opportunities and maximizing outcomes. Tax planning isn't about how much money you already have. It's all about ensuring every decision you make today supports the wealth, security, and freedom you want tomorrow. In just a moment, Nathan will take us in today's topic on proactive mid-year planning for business owners. He'll share real world examples and highlight common pitfalls business owners face while showcasing how a proactive approach can transform the way you manage growth, cash flow, and long term goals. But here's a question I want to leave with you right now. Are you, as a business owner, real estate investor, or individual, leaving money on the table? At Tavola, we'd love to help you find out. That's why we offer a complimentary tax planning consultation, a no pressure opportunity to uncover missed deductions and opportunities, optimize the way your business finances are structured, and build a forward looking strategy. This isn't about selling you something, it's about giving you clarity. You'll leave this consultation with insights from professionals who do this every day, empowering you to make smarter, tax efficient decisions right away. If you're interested in booking one of these, my contact details will be presented at the end of the presentation. You can schedule using a link or sending us an email. So, with not further ado, I'm excited to introduce everyone to my colleague and friend, Nathan. Nathan's a CPA with 15 years of experience spanning both tax advisory and corporate controllership. His professional backgrounds include serving as a trusted business and tax advisors at both local and regional accounting firms, as well as leading the accounting operations for a multi-million-dollar portfolio of hotel investments. He has a particular passion for tax planning because budgeting and providing informative reporting that empowers clients to make smarter financial decisions. Beyond his professional life, Nathan and his wife stay busy with their 4 energetic young boys. Together, they enjoy family outings and traveling. Nathan is also active in his church community, and in his spare time, you'll often find him playing guitar, watching sports, reading, or occasionally on the golf course. Please join me in welcoming Nathan as he leads us through today's discussion in proactive tax planning.
Thanks, Matt. I'm so glad to be joining you today. I've really been looking forward to this discussion. Couldn't be better because we're coming up here on the end of the third quarter of the year. It's hard to believe that we're almost going to turn the calendar over into September and come up to the end of the third quarter. And right now, business owners and real estate investors still have some time to meet with their proactive tax planners to make decisions that could have a big impact on their taxes and their cash flow for their businesses. We can go ahead and move to the next slide. Some of the things we're going to talk about today are things like entity selection or deductions for retirement plans. We'll talk about real estate strategies, and what's maybe my favorite topic, we're going to talk about bookkeeping. Don't sleep on bookkeeping. It is critical for tax planning. It's a big deal. It might not seem like it, but it's one of the best ways to do effective, proactive tax planning. So excited to talk about that. Business owners and real estate investors are going to be successful in the big things like entity selection or compensation optimization or setting up a retirement plan for those deductions. They have to first master what seems like a small thing, and that's rock solid bookkeeping and accounting. So I'll try to stay off my soapbox, but it's there for a good reason, and we're going to cover that today. I think we can move to the next slide. As we said before, right now is the perfect time for business owners and investors to take a good hard look at the year-to-date financials. Look at their year-end projections. You maybe know what's coming up to the end of the year for your business or your portfolio. Take a good hard look at your investments because there are just about 18 weeks before we turn our calendars over into the new year. And at that point, it's almost always too late to implement any strategies that would impact the tax year. When it comes to our current tax year, 2025, I've heard it said that after December 31st, all your tax professional can do is record history. Right now, we can make history. So maybe that's a little bit pretentious, but it gets the message across. We only have 18 weeks left to be proactive, and maybe even a little bit less than that because some strategies take time. They may have some administrative work, you might need access to capital, and proactive tax planning will involve the movement of cash. So you'll need to have that cash available. You might need to set it aside. If you're buying property or if you're buying equipment, if you're using financing, lenders usually need some time to get those approvals in place. So proactive tax planners like us with Tavola Group are currently scheduling our third quarter meetings with our business owners and investors. So if you want to avoid surprises, if you want to know what your options are for reducing taxes or for improving cash flow, for protecting your retirement and protecting your wealth, make sure you're meeting with a proactive tax planner even in the next 5 weeks. You're going to need that time to make sure you're ready for when the calendar changes to 2026. So first off, we're going to start talking about equipment purchases. One of the big opportunity that business owners and real estate investors have before the end of the year is purchasing equipment for their businesses. So I'm in South Dakota, right? That's where my home office is located. I'm here in farm country. So what I've always been a part of, doing proactive tax planning for anyone in farming or construction, that kind of work, is advising these farmers or builders or their contractors on the impact of buying new equipment. And usually that involves trading away older equipment. But one of the benefits of buying new equipment right now is what's called bonus depreciation. In short, it's part of the tax code that allows the purchase of equipment to be a full deduction against business income. So let's take an example. Let's think of a contractor who buys a new work truck for about $75,000 and he uses it exclusively for the business. That contractor gets to reduce his or her business income for the full $75,000 if that truck was used in the business and placed in service before the end of the tax year. And then a 24% tax bracket, that $75,000 deduction saves $18,000 in taxes. The slide also mentions that tenant improvements, like leasehold improvements, are also eligible for bonus depreciation. So that's a big deal if your business is renting office space or needs to do any updates or renovations. Matt, did we have any questions on this topic?
Yeah, we just got two in, and I'm going to give you one at a time. The first is, do I have to pay cash or can I finance this?
Right, really good question. And the answer is yes, the equipment purchase can be financed. You can get bank financing, you can get manufacturer financing. The main thing is that the equipment itself or the truck itself needs to be placed in service by the end of the calendar year. But you don't have to pay for it all in cash. You can finance the equipment and purchase it that way.
All right. And then this one was, Nathan, thanks for the example with the work vehicle. However, I'm not in construction. I am an attorney, and I use my vehicle to go to see clients and to court and things like that. What type of vehicle can I buy?
Right. Yeah. Good. Thanks for asking that. So what will be eligible for depreciation is the business percentage use of the vehicle. So say you drive 5,000 miles, and these miles need to be going from the office to a third site, like going to a client or going to the courthouse. They can't be from home to office. They can't be commuting miles. But if you keep a log of your business miles traveled from the office or from your home to the third party site, whether it's court or your client's office, then you take that fraction, those miles over and against all the other miles that you drive, and that fraction can be applied to the cost of the vehicle, and that's what is eligible for bonus depreciation in 2025. Generally, you're going to want to purchase a vehicle that's greater than 6,000 pounds. So that is a larger SUV. But for an attorney, obviously an attorney isn't using their vehicle in the same way as a contractor would be using their vehicle, going to job sites and actually pulling equipment or trailers or things like that, hauling equipment. So that's where the business use percentage is very critical to substantiate and to do that even contemporaneous to when those miles are incurred. And we can talk a little bit more about the documentation of business mileage. But did you think I made that distinction pretty clear there, Matt?
Yeah, I think that's perfect. And thanks for the questions. I see a bunch of people are active on here right now. Keep the questions coming. And if we don't get to you or we see it after we move on, we'll do a catch-all at the end.
Okay, so when you meet with your proactive tax planner, One of the things he or she needs to also determine with you is whether your business activities are in the proper tax entity structure. And when I say tax entities, what I mean is the way that your business is organized in the eyes of the IRS. There's a couple of different structures that change the ways businesses report their taxable income. And I'll give you four of them. You have sole proprietorships, and those are businesses that report their taxable income on a business owner's individual 1040. Then you have a partnership. That partnership reports its taxable income on Form 1065, a partnership tax return. Then you have S corporation. That's a subsection of the tax code, section S, that is for companies that are organized as S. They've made an S election. They file their own tax returns. The income from the business flows through to the owner's 1040 according to their ownership percentage. And then you have C corporations, just a normal corporation that pays tax to federal and state governments. So the profits of a C corporation are taxed by the federal government and taxed by the state. So working with your tax professional the opportunity is to identify the perfect or the correct entity selection for your business activities. And where Tavola Group has seen a lot of opportunity has been working with business owners who were originally organized as sole proprietorships. Maybe a business owner started his or her own LLC. Maybe they didn't even do that, but the business has been reporting its income and for taxes on Schedule C of the business owner with his or her 1040. But over time, this business has grown perhaps to a net income of more than $200,000, more than $100,000, more than $200,000. And here's the thing, as long as the business is organized as a sole proprietorship, all of that net income, all of that $200,000 is now subject to self-employment taxes. That's the employee and the employer's share of Social Security and Medicare. That's 15.3% in tax on top of federal and state income taxes. But if you're working with a proactive tax planner, he or she might see an opportunity to make what's called an S election. And that's just a change to the organization to report its taxable income on its own tax return. But when this happens, it creates some opportunities for tax savings. First, an S corporation has to pay its owner reasonable compensation on a W-2. And whenever possible, that reasonable compensation should be lower than the net income that otherwise would have been fully subject to the 15.3 self-employment tax. So make this really simple. Let's take an example. Say you own a construction company that's generating $500,000 in net income as a sole proprietorship. Before that S election is made, the full $500,000 is subject to self-employment taxes. Now, Social Security is only taxed up to $176,100 in 2025, but the employee and employer share of Medicare is assessed on the full $500,000. Making an S election, the owner could say, the owner with their proactive tax planner could determine that perhaps $80,000 is a reasonable compensation for owning and running that business. If that determination is made and it's reasonable, now the owner only has to pay Social Security and Medicare, the employer and employee's share, on $80,000 salary instead of the $500,000 profit. Now those profits can be drawn, they can be like shareholder draws to the owner. They still want their cash flow. They can be shareholder draws to the owner, but they're not then going to be subject to payroll taxes. Only the $80,000 salary is going to be subject to those taxes. So I'm painting with a very broad brush here for the purposes of illustration. But for this example, that $80,000 wage would allow the business owner to save about $24,000 in payroll taxes. And when these elections are made, when they are made and how they get filed, they can be a bit tricky. And so that's why it's critical to work with your proactive tax planning professional. You don't want to have rejected elections. You don't want to incur penalties for setting things up incorrectly. You want to ensure payroll gets set up correctly. But this can be a powerful opportunity to discuss with a proactive tax planning professional. Questions from the group?
I was gonna say, Nathan, we got a lot of questions here. I think this is a hot topic, so let's just go from the order that we received them. How often do I need to run payroll, and does it have to be through a payroll provider?
Yeah, How often you run payroll is your discretion as a business owner. Especially if you're the only one who would then be taking compensation. If it's just you, you don't have any other employees that would need to be paid. Pay yourself monthly, pay yourself bi-monthly, pay yourself bi-weekly. It's at your discretion. What was the second part of that question? Do you need a payroll provider?
Correct. Yeah.
Yeah, yeah. I mean, ideally, it is best to use a payroll provider like QuickBooks Online Payroll is one. Our firm has really good experience with ADP. We can set up ADP for you, with you. Same thing with Gusto. Gusto is a really user-friendly payroll provider. And those payroll providers, they take some work out of your hands because when payroll is run, it calculates the payroll tax liability and goes into your bank account and remits it to the appropriate jurisdictions, federal, state. And so you don't want to set that up on your own. You want to work with a professional. You want to work with someone who has experience in setting up payroll. But a payroll system like an ADP or Gusto or even QuickBooks Online Payroll, those are essential to running payroll after you make an S election.
All right. Following up on the S corp election, is there a cap on the amount an owner can pay themselves via payroll?
There's not a cap, but I think maybe think about it from a different perspective. Where we want to achieve a delta is the difference between the profits of the business that would have otherwise been subject to payroll taxes versus what we would cordon off as salary or wages. And so the salary and wage have to be reasonable. You can't, as let's take for example a doctor. A doctor can't say, "Hey, I want to. My clinic is making $500,000 a year, and I don't want to pay the payroll taxes on the 500. I'll make an S election. I'll pay myself $40,000 as a wage." I'm sorry, you're a medical professional. You're a doctor. You have graduate education and professional licensure to maintain. It's highly educated, highly regulated, and so it's going to be highly compensated. It has to be reasonable. And I've worked even with an organization that very quickly, very easily, it took my client about 30 minutes to complete a survey to identify reasonable compensation based on her activities in her business. Well, not a medical professional, but in her business. She answered a survey, took about 30 minutes, and now we have a high level of confidence what her reasonable compensation is if ever the IRS had a question. And the reason is they don't want to see a very low wage because now obviously you're saving on payroll taxes. They say, hey, you're taking those distributions free of payroll taxes. Those ought to have been salary. But if that was to ever become a question, now this client has a good study that we can point to and say substantiates the salary that was identified for her from her S corporation. All right, we'll talk a little bit about retirement plans because retirement plans are one of the largest levers for small business owners. And there's two that I'm bringing to our attention today. We've got a SEP IRA or a solo 401k. They operate a little bit differently, and so I want to kind of talk about what is distinctive between the two of them. But a SEP IRA allows business owner to contribute about 25% of earnings. So take, for example, a business that has $100,000 of net income, 25%, so $25,000 can be an expense of the business as retirement savings. $25,000 can be put into the SEP IRA and taken as a deduction from business income. A solo 401k lets a business owner add both an employer piece and an employee deferral. And between the two, the employee deferrals from salary and employer match, a total of $69,000 or $76,500 could be deducted from business income, contributed into the solo 401k. And what you've done is effectively put money into your retirement and gotten a deduction from your business income doing so. There are differences, a couple other differences between SEP IRAs and solo 401ks. The SEP IRA, if you have employees, whatever you contribute into the SEP IRA, you have to also do for any of the employees. The solo 401k really doesn't make sense if you do have employees. As I kind of mentioned, the solo 401k has a higher threshold of contributions that can be taken as retirement expense for a business in a given year.
I got a question right away, but you already answered it, which was with either of those options, can we just give myself contributions but not employees? So you already
Right.
covered that. Way to
Yeah.
anticipate.
Right. And we've worked through some analysis for some of our clients, that have employees. Do I use a SEP IRA? What wasn't even listed here is maybe a safe harbor 401k. That's another option. But I think what we're emphasizing here is working with a tax planning professional allows a business owner to evaluate the proper retirement plan that can be used to reduce taxable income year over year while growing wealth in a retirement account. One thing that you could talk about with a tax planning professional is what is referred to as a short-term rental loophole. Short-term rentals, think Airbnbs, think VRBO, they can operate as an active trade or business on a business owner's 1040. It would file on Schedule C. It would report all of its profits and expenses, or all of its income and expenses on Schedule C, as opposed to a passive rental that reports on Schedule E. The best thing about a short-term rental is you can engage our firm to compose what's called a cost segregation study. And what a cost segregation study is, simply take a $500,000 rental property, what would have otherwise been 27.5-year life, and you would only be able to take the $500,000 investment, you would get an expense over, you would have to divide that essentially by 27.5 and take that expense against your rental income year over year. A cost segregation looks at a property and says, okay, within this property there are cabinets, there are toilets, there are sinks, there are light fixtures, and all of these various components within that larger rental have a shorter useful life. And when the useful life, according to the IRS designations, are 15-year or less, and that's things like the cabinets, the toilets, the light fixtures, the sinks, when the useful life of those assets, whatever value is associated to them, those assets are eligible for bonus depreciation. So just like we talked about trucks or equipment producing depreciation that is going to offset business income in the calendar year, the same thing can be said for short-term rentals. Just using really round numbers, on a $500,000 rental, it's maybe fair to say that 20 to 25% of the cost of that rental is, so maybe like $100,000 is the 15-year or less lived assets. So $100,000 can be accelerated depreciation and offset earned income or investment income, and drive down your taxable income. I have a note on the slide talking about the benefit of the calendar and how the calendar can be your friend as we come to the end of the year. Because a lot of people want to own real estate, they want to own short-term rentals, but not be property managers. The way to make sure that you still get the deduction for the depreciation from a short-term rental is to have active management in the short-term rental. And that's 100 hours or more than anyone else. So that does generally preclude investors from hiring a property management company to just run everything from the Airbnb. But think of the calendar as being your friend, because right now, if you were to close on a property in October and start renting it out in November, okay, you only need to actively manage this property and manage it more than anyone else for those 8 weeks, November through the end of the year. When the calendar turns over and January 1st, you could hire a property manager and just sit back and collect the cash flow off this property, because if you did the cost segregation study for 2025, you would reap the benefit of that accelerated depreciation in 2025 and not need to worry about it going forward. You've already captured all of your savings or already captured all of your deductions for 2025. I've got a caveat there that planning is essential for this. Cost segregation reports take some lead time. Some things will be required of an investor, like the appraisal or a home inspection or and photos of the property. And all those things need to be brought together to produce the cost segregation report. So this is one of those areas in which the calendar can be your friend, but also make sure that you are proactive and working with your tax professional early and often, so you don't find yourself trying to rush to put a property in service before the end of the year, or even miss putting the property in service before the end of the year. If cash left your bank in 2025, you want to get the deduction in 2025 as well. Any questions there?
Yeah, so I see actually a couple duplicates, and I'm just going to try to summarize these three similar questions into one. You mentioned qualifying material participation hours or self-management. Can you, and not using a management firm to qualify for the short-term rental loophole, can you give some examples of what those qualifying activities would be?
Sure. Qualifying hours, and I want to make a mention too that just like if you're a business owner and you're tracking mileage, say you have a mileage book in the console of your car, the IRS wants to see contemporaneous substantiation of those miles that you traveled. There are apps, there are tools online, or simply calendar books or appointment books, where you want to contemporaneously document the hours that you're engaged in any activities on a short-term rental. There are hours that qualify for active management and there are hours that don't. So hours that don't, I'll start with the ones that don't. Hours that don't are things like just reviewing other listings or reviewing the financials or talking to your accountant, for any kind of income tax planning purposes. The IRS would consider those investor activities. What is active management are any activities that you would do that would, if they weren't done for the property, it would cease to function as a rental. So things like communicating with guests, if you're communicating with guests that are coming to stay, checking in, checking out of your Airbnb, restocking supplies on the premises, doing any maintenance on the premises. Uh, those activities qualify as active management hours, even communicating with vendors. So I even think theoretically you can hire some property manager, or to a certain degree, you can have people come in and do things for you as the owner. But what is essential is that you have 100 hours or more than anyone else managing the property with those kind of activities. Is that pretty clear?
That's great. And one of the questions was, does this mean I have to clean the toilets? Uh,
I
so,
think, right. I think, that, I mean, it would be hours that qualify you. You can hire that out. You just want to make sure that maybe then you're going and cleaning the sinks.
uh, this is a great question. What's the If I do the short-term rental loophole on my taxes, does that mean I have the REPS status, which for those that don't know, that's real estate professional status on your tax return?
Yeah, real estate professional status is a good question. It's kind of a hard thing to achieve. If you are active in real estate, like that's all you do, and you're self-employed, you're buying and selling houses, you're managing rentals, you can qualify for as a real estate professional. The other thing I would say though is it's not necessary. Like that's why this is called loophole, is you can get the losses, the depreciation losses from a short-term rental through 100 hours or more than anyone else managing this property. And you don't need to be a real estate professional. There's really some easy things that would even disqualify people from being real estate professional status. It's pretty well out of the question if you have a full-time job. If you have a W-2 or a full-time job, it is about impossible to be considered real estate professional status. But it's not necessary. It's not critical for reaping the benefits of investing in real estate. the active management hours that you put in, even if it's only for a few months, if you time it right, you only need to actively be there for a few months, and then you can hire a property manager and not need to worry about being on premises or cleaning the toilets ever again. Um, so without having to ever worry about real estate professional status. Talking about real estate, 1031 exchanges are a hot button issue. 1031 is a code section within the tax code that allows real property to be traded for other real property. And when that is done, say you purchased a rental property for $100,000 10 years ago, and it's gone up in value. And now someone would gladly buy that property for $500,000. If it's an investment property, it's had some depreciation, and so there's now a low cost basis in that property that was purchased. And the $500,000 sale now incurs a big taxable gain. But what can be done is utilizing a qualified intermediary. You can see we've got a webinar that we did with deferred.com, but you can use a qualified intermediary and you can set it up so you can sell a property, have the proceeds from the sale go to a qualified intermediary. You can't touch the cash, but then you have 45 days to identify a replacement property and close within 180 days and have that qualified intermediary take the funds that you got from the sale of your first property, put it into the purchase of the new investment property. And what you've done is you have deferred any of the gain that you would have otherwise picked up had you sold the investment property at that larger gain. So the taxable basis, the net book value of the investment property effectively rolls into the new investment, the new property, and no taxable gain or no taxable sale qualified or triggered a taxable gain. But like I said, there are strict rules when it comes to these 1031 exchanges, and so that is another reason why in these next 8 weeks you would want to visit, or ever, if you ever have the need to or the desire to purchase or to trade an investment property, you want to work with your proactive tax professional to do whatever you can to identify a replacement property and defer any of that taxable gain.
This is a very specific question, but I have a short-term rental that I would like to sell and buy a family lake house. Could I do a
Yeah.
1031 exchange for that?
Yeah. Where the rubber meets the road is it has to be like kind property. And so you have a rental house and you want to get a lake house. They're both houses, but they're not like kind because the lake house isn't an investment property for business purposes. So the replacement property can't be for personal use. It has to be for business use or as an investment that would produce income. One thing you should talk about with your proactive tax planning professional is the Augusta rule. It's named the Augusta rule because the Masters is in Augusta, Georgia every year. And many, many years ago, the people who were renting out their homes during the Masters tournament said to Congress, hey, we are not landlords. We don't want to report taxable income for renting our house out during this golf tournament. And Congress said, you're right. You're not a landlord. You can take up to 14 days of the year. You can rent out your primary residence up to 14 days of the year, and you don't have to claim that as rental income. Now, if you're a business owner, this creates a really cool opportunity because you can enter into a rental agreement with your business and be landlord to your business and have your business rent from your primary residence, meetings for strategic incentives. But what the business does is records the rent as rental expense, so you can deduct rent expense on your business profit and loss and pick up the rent paid to you, business owner, tax free because you rent out your house less than 14 days of the year. Proper documentation is a big deal. You want to have a rental agreement. You want to have meeting minutes anytime your business would ever have a meeting at your house. The documentation should show the dates or the purpose of the meetings at your residence, and you need to establish what is the fair market value of your home, what's the going rate, so that you have good arm's length proof of why the business paid $500 to have a strategy meeting at your house. And we have templates, and I've worked with many business owners customizing these templates and using them whenever they have their meetings at their primary residence, so that there's always good, proper, contemporaneous substantiation for any of these rental activities. Along with the Augusta rule, another way to get tax-free income or tax-free cash flow from a business, or to even reduce taxable income and get cash flow out of the business and to the owner, is to establish an accountable plan. So accountable plans are reimbursements, and they're tax-free reimbursements for expenses that a homeowner incurs out of pocket in running the business. And that's things like mobile phone, that's things like home internet, that can be mileage incurred when you're doing client visits or going off of site. The business can reimburse the business owner for even the business owner's home office. You could do something as very simple as $5 per square foot of the home office is rent expense to the business, and that reduces the taxable income of the business or reduces the taxable income of the business owner, and the business owner gets to collect that cash flow tax free. These plans must be written. The reimbursements must be handled consistently with the plan. And so working with a proactive tax planner, we have templates, we have tools that we put into place. I'm going to pivot a little bit into the bookkeeping component. We either do the accounting or we work with the bookkeeper to ensure that the reimbursements aren't mistakenly categorized as draws, because you want to make sure it's an expense. You want to make sure the business is getting the expense for the mobile phone and it's not being miscategorized as a shareholder draw or anything of that nature. And so working with a proactive tax professional makes sure these accountable plans are locked down and bulletproof in the event of any questions asked.
Real quick on two questions that I'm seeing here. The first one is, can I pay for Spotify or Amazon subscriptions if I'm using it for my business?
Right. So like a doctor's office is piping in music.
Yeah, that'd be my guess. Yeah.
Okay. Yeah. Yeah. I mean, that you're using the music in your business. It's an ordinary and necessary expense of your business. Then absolutely. You might get some personal benefit from that Spotify subscription. You obviously have some personal benefit to your mobile phone that you pay for every month. Just because you have personal benefit doesn't mean it's also an ordinary and necessary business cost that should be fully deductible to the business.
Gotcha. With this accountable plan and reimbursement, is there a frequency we have to do this? Is it monthly, biweekly, within 30 days? How does that work?
Yeah, I mean, that can be designed plan by plan. The main thing is that it's done consistently. I think if at the end of the year you suddenly have this rush to reimburse a business owner for 12 months worth of business expenses, it just raises some questions about record retent or record keeping and documentation. So I think something as easy as once a month or done contemporaneous to payroll makes a lot of sense for business owners. We'll talk a little bit about estimated tax payments. Working with a proactive tax professional will ensure that you don't incur penalties unnecessarily for not paying the majority of your tax liability by the 15th of January in a given tax year. And so like I said earlier, we're in third quarter meetings, and even for our clients, we're working through their year-to-date financials and assessing their profitability throughout the entire year and providing to our clients estimates that can be paid on a quarterly basis to reduce the amount of cash that would need to be paid otherwise in the springtime when the taxes are filed. When a business owner or an individual doesn't pay the expected amount of tax throughout the entire year, and that's like 90% of the year's ending tax liability, you can face some pretty steep penalties. These penalties are obnoxious, they can be avoided, but at the same time, there are some business owners who consider the estimates and consider the penalties as costs of capital and don't pay estimates. The estimates are, at the end of the day, discretionary. They're not required. So it's always a discussion with a proactive tax planner. And the estimate, especially when you're doing tax planning, can change because to this point throughout the year, you might have $100,000 of taxable income. But if part of your strategy is to go out and purchase equipment, now your taxable income has substantially changed and your estimates should change too. One of my, like I said, my pet topic, bookkeeping and documentation. One of the most effective tax planning strategies any business owner can enact is really solid bookkeeping. Very well done bookkeeping allows you, the business owner, and the accountant to ensure that every deduction is captured. When bookkeeping is reactive or roughly non-existent, it is very difficult for the business owner to remember the classifications of transactions that occurred 9, 10, 11, 12 months ago. And if the business owner doesn't know, it is impossible for the accounting professional to know. So getting 12 months of bank statements or credit card statements in February of 2026 and being expected to pull together a profit and loss for 2025 for someone's rental property, I will guarantee you that expenses will be missed or they will be miscategorized, and it will become that much harder to implement any applicable strategies that would have made sense for a business owner. So it doesn't get a whole lot of attention and it's not seen as very sexy, but bookkeeping is a critical way to ensure that you get all of the deductions, business owner, that you are entitled to receive.
Someone just wrote in saying, hey, there's a lot of different things that I've considered, software, spreadsheet. What are your recommendations on tracking, from not just expense tracking, but, profit loss, deductions, and do you have a recommended software for that? And at what level should we consider it?
Yeah, I honestly want to say, or I feel the need to say that it's important that a business owner would probably get the best accounting software they can afford as early as they can afford it. The good news is it's all generally pretty affordable. QuickBooks Online can cost anywhere from $40 to $90 a month. It's a business expense. It reduces taxable income. It also provides real-time view into the profits and losses of any kind of a business. These accounting softwares, whether it's QuickBooks Online or Xero, have APIs that link to the business bank accounts and the business credit cards, and rules that can be established within the QuickBooks file to automatically categorize transactions as they come through. And so whether it's a bookkeeper or you yourself doing the bookkeeping, it can be less time consuming. The results of bookkeeping can be seen quite quickly and easily. So I would recommend utilizing something like a QuickBooks Online or Xero sooner rather than later. Trying to do a recap of profit and loss or any kind of business financials on the basis of Excel workbooks is going to lead to human error or even just miscalculations. It's easier to work with a system that handles all of the transactions that come from the bank accounts and is linked from the start.
Well, we got a lot of opinions on people on their preference over Xero or QuickBooks in the chat. So thank you for all of that.
We're circling back to the entity selection question. I think this slide is referring to reasonable compensation, which I referred to when we were talking about making S elections. So what I'm emphasizing with this slide is effectively necessity of meeting with a proactive tax professional and making decisions for reasonable compensation and payroll setup with that tax professional. So in summary, all of these tax strategies, they require some lead time. They require some documentation. They require a business owner to understand his or her cash flow because the movement of cash will often be necessary to accomplish different tax strategies. And so acting too late will reduce the impact of any strategies that would have been more powerful if they were implemented earlier. And so that's why this was such a timely discussion, Matt, that we can talk about all of these different opportunities that proactive tax professionals can bring up with clients, bring up with business owners, real estate investors. Now is the time. We've got about 8 weeks. We've got about maybe even 5 weeks where you want to schedule a meeting with your tax professional and have these discussions and get someone to help you understand what moves you can make to reduce your taxable income.
Well, thank you, Nathan. That really brings us to the end of today's session. I know we're coming right up here on time. If anyone's got extra questions, I know we didn't have time to go back. I missed a few questions. Please feel free to reach out to Nathan or I directly. Our contact information is on the screen. If you'd like to take next steps, we'd love to have a chance to connect with you, whether it's a specific question today or actually diving into a free consultation. You can reach out directly to me. Big thank you to Nathan and the rest of the Tavola Group team for helping us prepare and put this on. We're here as a resource for all your accounting needs. We truly appreciate your engagement today. There's a lot of great questions. I truly appreciate that. It makes these a lot more interactive and fun. And we're looking forward to helping you guys protect more of what you've earned while building long-term wealth strategically.